Hey everybody, this is Tim Dial with Nexum Mortgage, and I just wanted to put this short video together to go over some exciting news today, or at least it's exciting for mortgage rates because we got the new BLS Jobs Report, and there have been many months in a row where we have felt like the BLS job numbers should have been much lower than they were showing. And turns out we were right all along because they've made huge revisions, and it's very clear that the Fed has screwed up royally and should have been cutting rates before now, and they're still just holding. If this data had come out previously, then I think they definitely would have made a rate cut here at the end of July. But they did not, and this data was not available, and the data that they were using was wrong. So we're going to get into this right now and go over it a little bit. I'm going to go ahead and share a screen because Barry explains this a lot better than I can. So I'm going to share this. This is MBS Highway and Barry Habib, who is an incredible expert on this, and I follow him all the time because he's so good at this stuff. So, oh, hang on a second. I've got to do something here on this share. I did this a little bit off, so let me try it again. All right, so I forgot to share sound. We're gonna need to share sound for this to work. So let's see here. Try this again. Okay, and so I'm going to go ahead and play this, and he's going to explain what's going on in the BLS Jobs Report and how that's impacting rates here.
That not only do we get a number today that's reflective, but the revisions speak the truth about what has been going on. So let's break this down for you, because I feel that this is a really critical report for us to be looking at here. Okay, so the number came in pretty weak. Only 73,000 jobs, according to the BLS. This is their business survey. They were expecting about 110,000. As you know, we've been telling you that. So softer than expectations. But where did it all come from? It all came from healthcare and social assistance, 73,000 jobs. It all came from there. Not exactly drivers of economic activity and solid job growth. Leisure and hospitality, by the way, some softness there. Finally, only up 5K. That starts to make sense because we've been hearing that, you know, with tariffs, with people traveling less to the U.S., these numbers, and with all of like the Airbnb's numbers being down, we've been hearing that leisure and hospitality should be down, but yet the BLS was force feeding us these big gains, finally a dose of reality. But here's where it really gets interesting. When we think about the birth-death model for this month, it showed we gained 257,000 jobs. Ha! We don't believe it. It's going to get revised lower. This is a freaking joke, folks. It is a joke. So you can imagine this would likely be a negative number. Remember, this is not seasonally adjusted. This is. So it would likely be a negative number if the birth-death model were more realistic. Now, as it turns out, just a couple of days ago, we got the revision to the fourth quarter's birth-death model. And guess what? It was revised lower by 170,000. Now, speaking of revisions, this is now from the BLS, the revisions to their reports for the past 2 months, for May and June, were negative 258,000. You heard that right. 258,000 of the jobs they told us that we had in the last 2 months never happened. What does that mean? In May, they told us we had 144,000 jobs. It's only 19,000. In June, they told us we had 147,000 jobs. It's only 14,000. We have seen average negative revisions per month in 2025 of 77,000. And team, we have been punished. Now, the problem with this, obviously, is that the market doesn't go back and correct what it did. It always just looks forward. It doesn't go back and take these revisions and adjust pricing for it, although today we're probably seeing some gains because of these revisions. But let's see how badly we've been punished. Take a look at this. You remember the series The Punisher? Well, forget Marvel. It's been the BLS. And the amount of punishment that we received, so that June 6th jobs report, we saw 52 basis points of losses based upon that. The July 3rd one, 71 basis points of losses. Would we have even come close to seeing that the market would have rallied if we were 14,000 jobs, 19,000 jobs? The market would have had a very big rally instead of punishing us. And you saw that the 10-year also rose significantly. One was 25 basis points, one was 13 basis points. We got hammered.
So anyway, that's Barry going over a lot of that data, and now if you look at what's happening today because of these big revisions and the bad job numbers, this is what mortgage bonds are doing. They are rallying right now. We're getting to the highest level that we've seen all the way back to here, and much higher than we were over here. So we're probably going to break above this next week if this continues. And then on the 10-year, if you look, we always like for the 10-year to drop. It moves the same direction as long-term mortgage rates. So the 10-year, we want to go down, and look where it is now. It's getting down to these lowest levels we've seen, and we want it to break below this. And so, but this is a huge drop right here for the 10-year. It was struggling to get below this 200-day moving average, and then we broke below it over the last couple of days, and now look where we are at this point. So well below it now, and so this is a very good sign for what's going on in the mortgage market. That means we're making big gains on rates right now today, and hopefully this will continue into next week. But this does tell us that the Fed's decision not to cut rates was a huge mistake. They should have already been cutting rates months earlier, because these job numbers, if these job numbers had been accurate and showed that incredible amount of weakness in the job market, the Fed would have already been cutting rates. But because they've been using fake numbers, they didn't do it. And now there is no Fed meeting in September, in August. So the next Fed meeting isn't until toward the end of September. And so we've got to go through basically 2 months of not having a cut when they should have already made cuts, and so that's a problem. But we will see gains in the mortgage industry just because of these bad job numbers, and we will see the market reflect that to some degree. Not as much as if the Fed were doing what they should be doing, but it will still be helpful. Now, I think that if this kind of data continues, what they should do in September to make up for their blown cuts is they should do a 50 basis point cut instead of a 25, to try and make up for some of their misses. But I don't know that they'll do that, because unfortunately Jerome Powell is kind of an idiot, and there's nothing we can do about it. We're just, all we can do is wait it out until he's out of there. So, but he will be replaced next year, but it's going to be tough sledding until that happens, because he's been behind the curve on everything that he's done. I mean, he was way late way late raising rates when inflation started. He kept saying it was transitory, and he was wrong. And so now he's way late on lowering rates, and he's going to cause us to go into a recession if we're not already in one. So that's just the way it is. But anyway, we will see the rates really drop over the next 6 months because of the data we're seeing, and it's finally catching up. And so we're going to see, I think that the rates within the next 6 to 9 months will be like 1 full % lower than they are today. So, there's good news ahead, and so stay tuned.